So when we talk about buy and hold, right? A lot of people who only know stocks, they always like to buy and hold, right? They don't have time for the market. So for buy and hold, we look at the long-term trend, right? Especially for the overall market, 5 to 10 years, yeah. And in the short term and the mid-term, there's always fluctuation, correct? So the market don't go up in a straight line, agree? Market always go up in a wave pattern. It goes up, like breathing out, then breathe in, then breathe out, breathe in, just like a wave, all right? So this wave pattern form a short to mid-term trend, all right? And everybody who actually experienced the roller coaster of market, they will tell you their 1997 Asian financial crisis story. It goes down, and how much it goes down, and how much it rebound back up. So the next one. So, yeah. So of course, when market goes through this kind of cycle, we experience pain as an investor. Yeah, it's called a market crash, and also the forced rally. It goes up suddenly, it reverses. Can be 90 degree, 180 degree, and everybody is like wondering, oh my God, whatever profit, give back to the market. Yeah. So this kind of short-term pain, how can we overcome it as a gain or turn it into a gain? That's where option comes in. Yeah. So we look at these are the three market conditions that we mentioned: bull, bear, sideways. Yeah. This is the most common market trend that we see day in and day out. It's called the cycle of market, and through the cycle, how we position the right option strategy, we can see trending. We call it trending versus flat market, okay? Or call it consolidation. So the next one, all the market trend, there's always a time when the market will form support and resistance, yeah? Which is your lowest low and the highest high. It's called, some people like to call it pivot point, some people like to call it support resistance. There are many terms for it. But especially when you look at technical analysis, there's always a zone. Yeah? There's no straight line called support line. Yeah? There's a support zone, resistance zone. That's why it's highlighted as green and red. Yeah? So this is basic charting that we can draw. So when it comes to option strategy, this is a summary chart on covered call. This is a very popular strategy when you hold 100 share. You just sell a call at a higher price to collect your premium or rental income. Yeah? So this strategy is basically, we define it as bullish or bearish. You can see the chart there is neutral to bullish. Then the second one is the theoretical profit is close to limited. And the third one is the theoretical loss is also limited. Why? Because you hold 100 shares. Then the last one is there time decay? There is time decay because you are what? You are option seller, correct? So this is the summary. And if you want to draw a P&L curve, owning the stock plus selling a call, you can see a break-even point. So do you need to calculate it manually? Don't need. You can use the option strategy builder. Yeah. So this is just a logic for you to know. Covered call is for you to wait for the price to go up, and if it doesn't go up to your target price, you can collect the premium income, yeah, as an income. So option gives you the second benefit that I mentioned just now. Next one. Yeah. So if you want to do it on the app, those who missed the previous session, this is the covered call step by step. So I like to use a process map as well. So the process map is a 5-step process map. Yeah, it's called the price. Okay. So go home. I hope you can remember and repeat the process. Okay, and think through it and understand this is option trading. You can go through the checklist by the first step, looking at the expiration. So always pick the right expiration. If you are short-term trader, you do short-term. Long-term, long-term. So of course, for the covered call expiration, we have shorter-term expiration, means you want to collect the premium faster, or you want to hold a longer-term expiration. That's the first P, all right? Then the second is R. R is you open your option chain. You can see, let's say I do a 30-day exam. Is it a 30-day? Yeah, 30-plus day example. Then you can review the strike and the grid. So most of the time, covered call strategy, we look at the higher out of money strike. And why? Because you have more upside potential and there's a less assignment risk because you are selling option. You don't want it to go in the money. Yeah. So that's where the 0.2 to 0.4 delta is a common balance between the premium and the assignment risk. That's the delta we look at. Then the I is for inspecting the liquidity. you must look at the bid and ask spread. So you must understand, is it very large or very close to each other? So if the bid is 250, then actually the bid is 250, the ask is, let's say, $2, so it's 50 cent bid ask wide. So we also inspect whether the 100 share is owned before we do a covered call. We must always check you are actually having 100 shares. If you already have 100 share, then of course you won't see the buy there. You will only see a sell call. Why? Because you can also link in the option. You can buy 100 share first, then you sell a call at a later time frame. All right. So make sure when you sell, the call is a sell, not a buy. Yeah. So you pair these two together. Then the last one, you examine the P&L. So the P&L is an enhanced yield curve. So you can see it goes up to the 186.5. So this is why you have a cap upside limit when you do a covered call. So after you look at the whole thing, you can execute. This is the flow the workflow for the app. Then we look at the desktop. So the desktop is the same thing, all right? So I repeat that so that you can say it loud to me, all right? So the first one is, when we pick, what do we pick? Expiration, all right. Then review what? No energy. Hello, we feed you well, right? The food not good enough, is it? God, yeah, review strikes. Come, give me some energy, okay? Review strikes and Greeks, correct? Then the next one, inspect the bid and ask spread, correct? Then choose the direction for call, we must sell, correct? Then the last one, examine the what curve? Profit and loss, correct? All right, so this is the covered call. All right, let's see the next one. Hello. All right, so yeah, no stock is mentioned here. So let's say you see the chart itself, you draw your support and resistance, correct? This is we call it the trading zone. So the trading zone, you can see the all-time high is what? At 329, is it? Yeah. So then, of course, in our Moomoo app, I would say Moomoo desktop as well, I like to use the analyst target and Morningstar value. So I can plot that as well. So when I plot that in, I can see a Morningstar value and also the average analyst target. So it's like currently is above the average analyst target and it's below the Morningstar value. So for me, if let's say my view is, that is potentially an extreme move away from the moving average. So I want to ensure that I want to collect some premium because I expect the stock price will go up and rebound in the short term. Yeah, it goes back to the moving average. So I can also use the market overview. That's the beauty about the desktop platform. You can see the support resistance, right? A lot of green over red. So let's say I draw my resistance. Then the next step I do is I see the Morningstar value is at around, what price is that? 340, right? Yeah, so the first thing is, the P is, I pick my expiration at 30 to 45 days. Just an example, all right? So that's the first step. So after I pick my expiration, I say at 30, 45 days. Then the next step is, again, review my strike price information. So my strike price information has the basic liquidity and also the Greeks, all right? So one of the feature that we have in Moomoo is the covered stock. You can use the covered stock feature, then you can click buy the ask, then straight away the strategy builder will show you the buy 100 share and sell the one call at 340. Yeah, so that is the automatic feature. Yeah. If not, you can also switch that to custom. Then you can actually choose add 100 share, then you sell a call. That you can do manually. Then the next step is, so this is one example, all right? So let's say I sell a 340 strike price. Then the next step is I want to review my premium. So I look at my mid price. So my mid price is $6.60. So what does that mean? So I assume my premium over stock price is 660 over 34,000. Based on 35 days, I'm collecting 1.94%, which is $660, if the stock price stay below 340 strike price. Yeah. So this is like in the next 35 days. Yeah. So I actually sell a call and I can get the value by having the individual sell call. So the next step, I can switch the table to the curve. I forgot to highlight. From the option table on the left-hand side, you can switch it to curve anytime. So when you switch to curve, straight away you see a sell call, which is the protection that you give yourself by selling a call. So this is considered just an example so that you can see how does a sell call works, okay? Then you can also put up the EM, the expiration date to actually fast forward and also play with the IV. The IV is also the scale on the right-hand side, 33.95%. So if let's say IV goes up, you can also see the P&L curve change. If IV goes down, you can also see the changes. So as a covered call trader, so would we want the IV to go up or go down? Anybody knows that? Go up? You want the IV to go up. Go down. Yeah, correct. So yeah, so you can actually, the IV, you play around, you see when it goes down, actually, because you are selling an option, correct? You want IV to go down so that you can enjoy the profit curve faster. Yeah, so then the last one, after you check your P&L and your break-even point, oops. Yeah, then as a single leg option trader, you can also preset your take profit and stop loss. So before you even take on your trade, you can also go down and look at your take profit and stop loss. Then you can put your value. So let's say this is $6.60 as an example. So because we are option seller, so my stop loss is at $4.40. Means how much I can potentially lose for this trade. Anyone knows? Don't know. Or no, too shy already, is it? So you can actually go use your mouse cursor, you move over there, you use 6.6 minus 4.4, it will show you lose estimated up to 220, right? So your take profit is, let's say, 2.2. So then you can actually take profit at 330. Okay, so for scenario consideration, so without share, with 100 share, so it's very important. So with this covered call, you must always remember, you must pair it with the stock, all right? So if it's only a sell call, it's considered a naked position. So it's not a covered call. Then with 100 share, you sell a stock at the strike price that you wish based on the price systematic process map approach, okay? Then the covered call option strategy, you can always consider theta and volatility change that can affect your option strategy. So this is what we have to consider for covered call. Next one. A previous one. Yeah, so protective put is another strategy that you can use to be cautiously bullish. Means you want to protect your stock holding when the market tank and your stock price go down. So the stock price has to move a lot, then you can realize the profit from an option for this option strategy. So it's basically an option buyer strategy. So it's unlimited profit, limited risk, correct? So based on this chart, we can see there's always a break-even point based on the premium that you pay, okay? So the max loss is that, and also for a max profit is, as long as this is a buy put that you put in, whatever amount you pay, you lose the maximum amount, and whatever profit it is unlimited. As long as the stock price go even zero, you will enjoy maximum profit. Yeah? So that's why you can see the curve is like an L shape. So for protective put, same thing, the PRICE approach. So pick your expiration. Because you are option buyer, you are buying an option, you may want to go for a longer expiration. So you get more protection, but the cost will be higher. All right. Then the second one is your R. When you review your strike, you have an option to buy the put at the money, out of the money or in the money, correct? So at the money will give you that maximum protection. Then once you inspect the bid and ask spread, then you can choose your direction, make sure it's buy for protective put, and then examine the P&L curve. All right? So P&L curve is definitely, when you look further, the downside is always a cushion. So the cushion is you will profit when you go past your break-even price. So let's say the stock is at $100, you buy a put at the money $100, you pay $2 for the put, so you will only profit from it when it goes $98 and below, right? So that's what you have to consider for the E. So this is the protective put case study. Yeah, make sure PRICE. Then we can look at example. So the example is I'm showing here is that you can buy a put when we see it's touching the support, and you have a view that it's going to break the first support going to the next support. Yeah. So this move is considered a stop price move. So from what price? How many points? So let's say it's this is at 170. Then it will go to 140. Yeah. So after you plot your technical analysis, that's where you can come in using the strategy builder. Yeah. So why I need to highlight the strategy builder? Because this is a trade that you can do it independently, just trading the option without holding the stock. So you can say, I'm very bearish or bearish. So when you click on this tool, the first thing, we go back to the previous one. Yeah, time or money more important for you, correct? Time frame or money means the budget. So for this example, I use target price. So that's another way to look at it. You say, I want the price, I forecast the price to go down to my target price, 140. Yeah, so that's the third way to understand option. Then only you set your target price. You say, I expect the stock price to travel from point A to point B. You have a target price. Then only you set your budget and your time frame. Yeah? So that's the beauty about this strategy builder. You can choose your own parameter. After you set your parameter, then you also can adjust your return and probability. And from this example, if I am very bearish, which option can I choose for protective put? Long put, short call spread, or long put spread? So just now, we did mention in the bull market, we can do a spread. So in the bear market, we can also do a spread. And yeah, don't listen to my advice. Always open up the strategy builder, see what the strategy builder give you as suggestion based on your return versus your probability. Yeah. So this example, there's a range. So you can say, oh, I want to experience the best risk-reward ratio. So I will try to find a maximum loss and a profit that is from 200 to 2,000 or 200 to 1,000. So that's your choice. Yeah. But for this example, long put is the one that is following the protective put strategy. All right. So this is on option buying. So this strategy builder will also suggest other sell strategy. So of course, you don't have to 100% stick to this suggestion. You can also open up the option P&L curve. You can adjust the buy put yourself. Whether you want to be buying the put at the money, out of the money, you can drag it further up, or you want to buy the put in the money. All right? So after you do that, make sure you have the right strike price and also the premium. Then we move on to the next one. Check your liquidity. So you can check the liquidity to see, because you are option buyer, you want to see how expensive it is when you enter the trade. And we can use bid ask as one of the metric, or the other metric, you can also use the field setting called the volume versus the open interest. Yeah. So once you have set your mind on the liquidity, then the final one is you can set your take profit and stop loss. All right? Same thing, take profit and stop loss. There's always a number you can fill in because this is a single leg option. Yeah? You cannot do a spread with the take profit stop loss. It's only for single leg. Yeah? So this is where the process of the price ends. And yeah, if you want to test out the strategy, you can actually paper trade without using real money. So this is the process flow price. And if you have anything you want to test on beside covered call and protective put, there's the strategy builder you can use to see how bullish you want to be or how bearish you want to be. Yeah. So these are some of the beginner-friendly strategy for those people who are starting off. When you are holding your stock, then you want to try out option, then you can consider these two different option strategy. Yeah. So yeah. So whatever it takes, then I actually end the whole process flow, and I'll pass the floor back to MC.
Thank you, Delvin.
Yeah.
Big round of applause, please. Thank you.